What if the thing keeping you up at night is actually your ticket to wealth? What if this 2025 recession isn't the end of your dreams, but the beginning of your breakthrough? Sounds backwards, but here's what most people refuse to see. The biggest fortunes weren't built during booms, they were built during crashes. 2008 created more millionaires than the decade before it. The Great Depression minted legends. The 2020 pandemic turned ordinary people into seven-figure earners. Right now, while everyone's panicking and cutting back, a small group is doing the exact opposite. They're positioning themselves to walk out of this storm wealthier than ever. So here's your choice. Let this recession destroy you like millions of others, or become one of the few who turns chaos into your wealth breakthrough. If you want the second option, don't skip a second of this video. Hit that like button and let's begin. Look, I won't sugarcoat this. Economic contractions are brutal. Storefronts go dark. Unemployment spikes. Cost of living becomes unpredictable. Families stay awake wondering how they'll survive next month. But here's what mainstream narratives never tell you. Beneath all that collective anxiety lies the most powerful wealth transfer mechanism in capitalism, the great redistribution cycle. These aren't just downturns. They're complete inversions of economic hierarchy. Institutional giants who seemed untouchable suddenly bleed. Assets locked behind impossible prices become within reach. People who understand these mechanics accumulate more capital in 3 to 5 years than most build in entire lifetimes. Picture a massive auction house filled with real value, equity positions, tangible property, operating businesses, hard commodities, legacy collections. Under normal conditions, prices are detached from reality. You walk through thinking, this is for a different class. But when credit contracts and liquidity dries up, the entire marketplace operates under fire sale rules. Everything once out of reach gets marked down drastically, 30, 50, sometimes 70% off. The catch? The crowd is paralyzed by fear. They see falling valuations as warning signs, but they're actually witnessing the exact moment generational wealth gets planted. Let me walk you through the underlying mechanics. What you need to grasp first is how systemic contractions create asymmetric opportunities. When aggregate demand collapses, asset valuations that were inflated by cheap credit and speculation suddenly correct to their fundamental worth. Equity markets tumble. Real property loses 30 to 40% of paper value. Even companies with solid balance sheets face existential pressure because consumer spending evaporates. Now, this looks like catastrophe on the surface, but if you're positioned with liquidity, patience, and nerve, you can acquire productive assets at massive discounts to their intrinsic value. Then when the cycle reverses and demand returns, those same assets appreciate exponentially. We're talking 200, 300, sometimes 1,000% gains. Look at the 2008 financial crisis. Absolute panic everywhere. Residential property lost half its value. Equity indices cratered by more than 50%. Foreclosures hit record levels. But who emerged wealthy? The ones who saw through the hysteria. Investors who bought distressed real estate at the bottom were sitting on seven-figure returns within half a decade. Stocks everyone thought were finished became wealth creation engines. This pattern repeats with mathematical precision. Every major crisis births a new wealthy class. The 1930s depression created investment legends like Joseph Kennedy. The dot-com implosion wiped out thousands, but made early Google and Amazon investors billionaires. The 2020 pandemic devastated hospitality and retail, but created massive fortunes in digital infrastructure and biotech. Here we are in 2025, sovereign debt at historic levels, corporate bankruptcies accelerating, market volatility through the roof. Fear is back. And once again, we're standing at the threshold of a once-in-a-generation buying opportunity. So the real question becomes this: will you let this cycle run over you like it will crush millions, or will you position yourself to capture what's being offered? Let's get tactical. How do you actually execute this? There are 3 non-negotiable steps, and the third one is foundational. Step 1 is capital preservation. Before you can deploy anything, you must secure your position. That means ruthlessly cutting discretionary spending, building emergency liquidity reserves, and eliminating all forms of consumer debt. Cash becomes your primary weapon during contractions. It provides optionality. It gives you purchasing power precisely when everyone else is forced into distressed sales. The cardinal rule here is simple. Don't exhaust your resources while the system is bleeding. Maintain fortress balance so you can move aggressively when conditions stabilize. Step 2 is strategic asset identification. You need to distinguish between assets that are cheap because they're dying versus assets that are cheap because of irrational panic. Focus on established enterprises that have survived multiple cycles, that produce essential goods or services with inelastic demand. During recessions, their equity prices collapse, not because their business model is broken, but because liquidity evaporates and margin calls force indiscriminate selling. That's your entry point. Real estate follows the same logic. When credit freezes and unemployment rises, property values drop sharply. But if you acquire well-located residential or commercial assets at steep discounts, you're not just buying shelter or space. You're locking in decades of appreciation and cash flow generation. Step 3 is patience and time horizon discipline. The fatal error most people make is expecting immediate returns. They think, I'll buy the dip and flip it for profit next quarter. That's not how structural wealth gets built. Real gains come from holding quality assets through the entire recovery cycle. 3, 5, 7 years later, when confidence returns and valuations normalize, that's when you realize those uncomfortable decisions during the crisis-generated, life-changing returns. Now, here's where it gets critical. Not every distressed asset represents opportunity. Some enterprises will collapse permanently. Certain sectors will contract structurally and never return to previous scale. So how do you separate signal from noise? You apply 3 fundamental filters. First, focus on sectors with inelastic demand, products and services people cannot defer or substitute regardless of economic conditions. Second, look for assets with proven cyclical resilience, things that have survived and recovered through multiple contractions historically. Third, identify situations where market price has disconnected dramatically from intrinsic value. Concretely, that means food production systems, energy infrastructure, healthcare delivery, core technology platforms, essential logistics networks. In real estate, it means properties in demographically strong locations with sustainable fundamentals. In business, it means companies solving enduring human problems, not speculative ventures. But let me tell you something even more important than asset selection. Your psychology will determine everything. Recessions operate on mass fear. Every media channel amplifies catastrophe narratives. Everyone in your social circle will counsel extreme caution. Your own family might question your sanity if you're acquiring assets, while the consensus predicts apocalypse. This is the exact inflection point that separates permanent wealth builders from the perpetually struggling. The wealthy grasp one fundamental truth. Fear-driven price dislocations create purchasing opportunities. Mass panic generates asymmetric returns. If you can maintain rational discipline while collective psychology disintegrates, you position yourself for extraordinary gains. Consider this framework. 2 individuals face identical external conditions. One perceives only threat and seeks maximum protection. The other recognizes that economic turbulence, while destroying capital in aggregate, simultaneously concentrates opportunity for those with resources and nerve. While the masses retreat to safety, the strategic few are deploying capital into assets that will compound for decades. That's the essence of cyclical wealth creation. The herd seeks shelter. The informed plant seeds that will yield generational returns. So what's your tactical playbook right now as we move through 2025? Begin with education. Develop deep literacy in the asset classes you're targeting. Track macro indicators. Identify which sectors demonstrate structural durability versus those facing permanent disruption. Simultaneously, maximize liquidity accumulation. Liquidate non-essential possessions. Eliminate discretionary consumption. Every dollar you save now becomes ammunition for strategic deployment. Opportunities are emerging daily. You need capital ready to move. When entry points materialize, start with measured positions. Acquire shares in fundamentally sound corporations trading below intrinsic value. Deploy capital into broad market index vehicles for diversified exposure. Target undervalued real estate in markets with long-term demographic support. Launch entrepreneurial ventures addressing problems the recession itself has created. Each action is like compressing a spring. The release will be powerful when growth resumes. The final discipline is temporal patience. Contractions are finite. They feel interminable while you're inside them, but economic systems always eventually stabilize and expand. Demand normalizes, enterprises restructure, innovation drives new cycles, and those assets you acquired at distressed valuations multiply exponentially. Wealth generation isn't about overnight transformation. It's about maintaining positions through the full cycle. Here's your binary choice. You can experience 2025 like the majority, paralyzed by uncertainty, reducing exposure, waiting passively for conditions to improve, or you can recognize this moment for what it actually represents, a compressed window of asymmetric opportunity. The repricing won't persist. If you can deploy capital while collective psychology is frozen, you'll look back years from now and identify this as the pivotal inflection point of your entire financial trajectory. Just like discovering this analysis, if you subscribe, you'll get ongoing perspective on these global economic dynamics. Hit subscribe, and if this framework added value, leave a like and share your strategic approach in the comments. I read and respond to everyone. We'll continue this conversation. Final disclaimer, I'm an economist, not a personal financial advisor. This content is educational analysis. All investment decisions and outcomes are your own responsibility.